Recently, the startup landscape has experienced a significant shift in funding strategies, moving away from traditional venture capital-backed models in favor of bootstrapping. Today, we're going to be talking about why traditional venture capital funding just isn't working anymore for venture capital firms and also for the startups they claim to fund. And to rise up in its place, we're going to explore the funding method known as bootstrapping in the contemporary startup world. But why is this happening now? I mean, there have always been companies failing, right? And venture capital firms know that by investing their money in a company, although they have the equity, that's not always a guarantee that that company is going to be successful. And we have tons of historical experience to show for the fact that companies have gotten millions of dollars invested into them, but have failed in the long term. So why are we seeing a significant shift now? If it's always been the case that companies have failed, why are we just now seeing the shift? The reason is the traditional model isn't working anymore. Now, the traditional method of raising money for your startup has always been pretty simple. You exchange equity in your company in exchange for funds. Those funds can either come from angel investors, outside investors, or venture capital firms. And some of those have trade-offs, but usually what it leads to is rapid growth within a company. But this isn't always a good thing. While VC funding can lead to substantial capital, it also entails a loss of control, and more importantly, a pressure to scale rapidly. Now, unfortunately for many VC-backed startups in the past, they find out all too late that it doesn't take as much money as you could possibly throw at something to make your business work. The fact is, there are all too many hundreds of millions of dollars of venture capital money going into startups that ultimately end up failing and fizzling out only a few years after inception. Because for these companies, usually it doesn't matter how much money you end up throwing at something, if you don't actually have value to provide to the market or a market to actually provide your value to, it doesn't matter how much you build or scale or grow, because if you're not actually going to be making money and sustaining yourself over the long term, or if you have such a niche product that is here for today and gone tomorrow, you're not going to have the ability to grow and actually scale into a full-on company. And there have been plenty of specifically internet companies that have faced this the hard way. Enter bootstrapping. Now, bootstrapping, or self-sustaining business growth, has rapidly become a more popular method of starting a business from scratch without raising very much outside capital. Let's talk about bootstrapping as a viable funding approach and the startups that have been able to be successful using it. Not only do these two different funding strategies differ in the way of just raising money, but they also traditionally have two very different business philosophies when it comes to actually using funds to grow your own business. First, let's talk about what makes bootstrapping so appealing. At the very top of the list for the reasons why someone would want to bootstrap their startup is freedom. Isn't that what all entrepreneurs want? Yes, freedom, creativity, and most importantly, independence. Independence from outside control, muddling about your startup, your business ventures, and your overall long-term goals. Now, while you may not have as much capital to start out with, having full control over your own business, the ventures it takes, and what you do internally as a company to succeed is very appealing for entrepreneurs who don't want outside forces muddling about and adjusting the business trajectory in a way that you don't want to go. Many successful startup founders have agreed that the actual control that they have of their business means that things are less stressful rather than not having the money at all. They would rather have full control over the business on whether it succeeds or fails than having outside sources who greatly have invested a ton of money into the business actually say and do what they shouldn't be doing and steering the startup off the path. But while they may not be stressed about control over the business, they definitely will be a lot more stressed about funds, and specifically where the funds are coming from. Things like resource constraints and lack of funds to pool in your business, whether it be on overhead, new materials, just honestly building anything that you're trying to do, is definitely going to be a much harder reason to start a bootstrap startup. Obviously, if you have the venture capital, you have usually quite a bit of money to get your business off the ground. And your opening door costs are going to be handled for you so that if you run your business plan right, you can eventually get to the point where you are profitable without having to raise all of your internal capital or actually going out and doing it yourself, which could take much, much longer. While bootstrapping does have that initial appeal of having full control, the fact is, if you don't have the venture capital to back it up, you could lose out on market opportunities. Things like competitors who can establish a strong brand identity before the bootstrap startup can ever get their name out into the world, and the ability to actually have things like office space, employees, etc. Everything that a venture capital firm would have that you would be okay giving up a little bit of control over to gain. This can often make it feel like a balancing act if you're actually running a bootstrap startup business. Things aren't always going to be as smooth as if you have hundreds of millions of dollars sitting at your disposal. But on the counterpoint, there are tons of VC-backed startup firms that burned through all of their capital for that exact reason. They simply had so much money that it seemed like their pool was never going to run out. The money was always going to keep coming. And for many of these companies, they don't know how bad they have it until it's already dead. That's why bootstrap startups are typically focused more on not diluting the equity, making sure you have more strategic management and financial planning that allows you to grow and scale at a pace that you're comfortable with. You're not going to have insane amounts of money to work with, but actually having that position to be in where you still maintain full equity of the business, it could be much easier to actually build a stable business product or service that meets the market need efficiently. That's why if you do run a bootstrap startup, it's incredibly important to have lean operations. It makes it so much easier to actually manage things if you keep your expenses lean. Things are not going to be going out the door as quickly, and you might miss out on a few things, but at the very least, you are going to know that by keeping your lean operations, you can maximize the amount of profit that you're reinvesting into the business year over year. And it's this sort of position that allows you to continuously refine your product to find that product market fit, without having to spend millions of dollars just testing things out. In the early stages, many venture capital firms that are actually investing in startups are investing based on an idea or a prototype or a very, very small example of who we could potentially sell to. So a lot of the early stages of actually running the business are just testing things out, figuring out what your product market fit is. Whereas with a bootstrap startup, if your money is not there, you're going to have to figure out that your product is working, because if it doesn't, then you're not gonna have any capital coming in the door to keep things afloat. So both of these methods, strictly bootstrapping your business and strictly having outside venture capital fund your business, have potential gains and drawbacks. So what's the solution here? Well, many startups have already answered that question already. And the method is a hybrid model, a model that blends the benefits of actually bootstrapping your startup with the benefits of having outside venture capital, actually demonstrating the viability for your business and the growth potential before getting any external venture capital backed money in the door. Because if you can demonstrate that your product, service, business, whatever is actually going to be successful on its own, then ideally the venture capital will only accelerate that. It's a lot easier to go from $500,000 a year in revenue to $50 million a year in revenue if you've got the solid team behind you and the right product market fit, as opposed to going from absolutely zero, just really testing things and guessing based on what your assumptions are, to $50 million that way. Now, I should not discredit the businesses that have done it. There have been one-hit wonders that have absolutely knocked it out of the park starting from zero. But those are very, very rare in the case of startups. But we're not strictly talking about raising money for your startup as if it's ones and zeros and just you're moving pieces on a chessboard. What we're talking about here is a cultural shift towards entrepreneurial independence. And that's what the future looks like. The future of raising money for your startup seems to be more founder-oriented on sustainable funding for the long term. Not just creating something insanely fast, having a rapid scale and exit strategy at the end of the day, but actually building for the long term. And that's more founder friendly, and I'm all here for it. But at the end of the day, this shift is already happening. We're already starting to see a more balanced and resilient ecosystem of businesses for the next generation of entrepreneurs. And that includes me. Whether we like it or not, the next generation of startups and businesses is already upon us. And us entrepreneurs have to face the music. Your story matters, your insights make the difference. So let's start the dialogue. Thank you guys so much for watching. My name is Josh, and as always, if you enjoyed the video today, I'd be really happy if you hit the subscribe button to see more content like this. And again, let me know down in the comments below what your thoughts were on this video. Do you agree? Do you disagree? Let me know. Let's chat about it. Until next time, guys, see ya.